We're watching this drama play out at the corner wall and Broad on Capitol Hill. Not that the two are really connected here. It seems to be taken as a given that this shutdown is going to continue for a while. The message from the newly formed Democratic House is that they want to go ahead and pass legislation to end it. But here's the kick. It has to be approved in the Senate. And Mitch McConnell on the wires now, and he has said this before, but confirming it now, that the Senate Majority Leader is saying the Senate will not take up any proposal in the shutdown that cannot get a signature from the president. We're already told that that will not get a signature from the president. So Mitch McConnell isn't going to put it up for a vote in the United States Senate, which means that essentially they're going to hurry up in the House to vote on something to put the baton into the hands of the Senate. And the Senate's not going to take the baton. So there we be. All right, meanwhile, stocks are falling on this Apple report on weak manufacturing data, concerns that what's happening in China isn't just in China. It's beginning to pick up global steam, and it is already sucking up the likes of semiconductor stocks, along with Apple suppliers, including Apple, including Ford, including a lot of multinationals, and right now about 28 of the Dow 30 stocks. We've got market watcher Craig Smith joining us, Susan Lee as well. Susan, this does seem to be indiscriminate, anyone and everyone.
Airlines also a major loser today as well. But, you know, there are some positives. I was just looking up at the up volume and the down volumes at this hour. You know, we're pretty much in line. They're pretty much equal at this point. At 10 a.m. when we had those horrific factory index, the ISM numbers come out saying that we saw the biggest decline in 2008. The buy to sell or the sell to buy was at 3-to-1. It was much more bearish at that point. So coming back to these even levels, I think is pretty encouraging. And there is one sector, by the way, Neil, I want to point out that is gaining today. That's a regional bank ETF seeing in advance, believe it or not. That's
very interesting. You know, Craig, you can tell me this because I remember when we were in the middle of what seemed to be a quick, albeit limited, spike up, you weren't buying it. And part of your rationale was there are bigger headwinds than we know right now. Do you still see the same headwinds?
I do, Neil. And look, the slowdown definitely has an impact. There's no doubt about that. This announcement from Apple was not good news. And the world is slowing for that matter. You see it in Germany, Japan. Our own Chicago PMI, as you mentioned at the top of the hour, is off. So, I mean, things are slowing. But I think there's a bigger impact here, Neil, and it happens to be the Federal Reserve. People are forgetting, Neil, and I'd like to remind your viewers what the Federal Reserve's mandate is. It's full unemployment, stable prices, and moderate long-term interest rates. The Fed is doing its job, Neil. They're reducing the balance sheet. They're raising interest rates, so he has tools in his tool chest. We're at 3.7% unemployment, full unemployment. We're at 3% growth. The Fed's done their job. They need to be raising rates, and they need to continue quantitative tightening.
You don't think they've overdone it, or that they risk overdoing it?
Neil, how can we think that they've overdone it when rates are at 2.5%? That's about half what they should be.
All right. You just scare me when you yell at me.
I'm sorry, Neil. I shouldn't take it.
No,
I'm getting emotional about this because I really believe the Fed has got its foot on the throat of the market. And maybe that's a good thing, Neil, because the market was very spoiled for 10 years with a Fed who was giving them free money.
You know, that's a very good point. You know, it's interesting, too, Susan, if you think about it, because we all got used to that, right? You know, I know you're too young to remember this yourself, but we got ready. We got used to near 0% interest rates. So when they go up to 2.5%, I'm like, oh my gosh! But I dare say there are a lot of folks, Craig and I among them, who could remember much higher rates, and returning to a different norm here. But what are you hearing on that?
Yeah, you know, so we were talking about this. Is the economy okay for 2019, especially with those scary factory numbers that we got at 10 a.m. today? And I would say, taking a survey from the investors and the traders that I talked to on the floor here, most are saying, yes, we're looking at moderating growth in 2019, but we're not at a recession. It seems like there is a lot of negative sentiment right now on the markets, and that's setting the bar pretty low heading into the first quarter. But expectations are, it looks like the Fed's probably not going to move this year, so we could actually see a pretty good scenario that could see a first quarter bounce, especially if we get a China trade deal signed.
Craig, are you in the camp that says markets can change the fundamentals? In other words, if markets tank enough, and we certainly saw this in financial issues during the meltdown, that it did affect their available capital because their capital was evaporating, and that something like that could be at play here. A Bloomberg report out right now that it is turning the fundamentals negatively. Do you buy that?
Yeah, I'd have to speculate on that, Neil, but it may well be the case. And look, we have to think about what the Federal Reserve is doing here, Neil. It's not like they're out to lunch. They started reducing the balance sheet in July. Anybody who didn't anticipate that that was going to make the market soften was not paying attention, Neil. And look, this Federal Reserve, Chairman Powell's been clear. He's got to put tools back into the tool chest for when we do hit the next recession. And I remember you talked about rates, Neil. I remember a time when rates were 9 or 10%. The stock market was doing fine during those times.
You're right. Susan, I mean, are the markets ready for that possibility, though, that in order to put more arrows in the quiver, so to speak, and you bring things up to a more accepted norm or historical accepted norm of 5%, let's say, versus 2.5% now, well, that might still be historically low. That's going to panic a lot of people, wouldn't it?
You know, so two sectors that have actually turned in the last few trading sessions after that really ugly December, of course, the worst since the Great Depression, are banks and oil. And that, to me, is indicative of a growth scenario for the U.S. economy. Yeah, so to me, that's, and obviously big money don't want to miss turns and trends. And so there is some more money rotating into oil and banks. And that seems like a more positive picture, certainly not a recessionary one for 2019.
All right, Susan, final word. Craig, final word to you as well. I always appreciate you guys. Thank you both very, very much.
Good seeing you, Neil.
All right, same here. Meanwhile, Edward Lawrence has the latest on how the White House has been